Hello, everyone. Welcome back to another edition of What's Happening Now. As always, remember to go ahead and comment and share this live broadcast. There could be some information not only useful to yourself, but to perhaps a family member or friend. Some of the things we got coming up with CNI Solutions is we're going to be having our Christmas Smiles events at the Bob Harrison Center. That's our annual event. We're excited about that. That's going to be happening next week. We are looking forward to that. If you hadn't had a chance to get your ticket, please go down to the Bob Harrison Center so you can get your ticket. So tonight's broadcast is being brought to you by Hello Guest Screen. Hello Guest Screen, it is offers an easy way to personalize your Airbnb properties, TV screens with custom images and dynamic calendar-driven guest information with all the necessities for information upon arrival. I tell you what, not only does Hello Guest Screen work good for Airbnb properties, we use it here at CNI Solutions. Every time we have one of our classes or we have a special event going on, we're able to use it for that, and it works out great. And I tell you, whenever our clients come in, they are just wowed by seeing that information. So tonight, I have some great guests in here who's going to give us some great information. We have Global Touch Mortgage LLC owner Frank Brown, and I'm going to have them introduce themselves, and we're going to get right into it because we ain't going to waste no time on this one. So, Frank, how's it going?
Doing well. How you doing?
I'm doing good.
Glad to be here, Charles.
Glad to be here. And
I'm Shauna. I'm a loan officer for Global Touch Mortgage.
All right. So we got that part out the way. Now let's get into it. Frank, what made you start this? How did you get into this?
Wow. I first started out wanting to be a real estate agent.
Okay.
All right. I had relocated to Georgia. I was working a job. I couldn't pay my bills. So I said, I need a second job. So I heard about real estate, started taking the classes, was doing pretty good. So you had to get licensed like most people know. And somebody told me about being a loan officer.
Okay.
When I looked into it at that time, you did not have to be licensed. So that means I could immediately get into working because I needed to make some money. So I ended up getting into the loan officer industry at that time.
All right. So, I mean, you don't see many minorities as loan officers or owning their own business. Was it a tough road for you to get started? Was you running into a lot of roadblocks, or did you find it coming to you effortlessly?
Well, it's easier to be a loan officer, a lot harder to be a CEO. I love the loan officer aspect of it. I love talking to our people. I love working loans. I love doing the numbers and figuring out the solutions. The CEO part, it is a lot of paperwork. It is a lot of red tape to be able to be a minority-owned institution and be a banking, being backed by banking and finance. You really have to keep your books in order. You got to keep your stuff in order. And we do that. We do what it takes to keep giving this money out to our people.
All right. And so you're currently licensed. I know here in the state of Alabama, where else are you guys licensed at where you're able to give out loans?
We service Georgia, we service Tennessee, and we can also service Mississippi.
Okay. That is outstanding. And so, Ms. Shauna, how do you come into this? I mean, his story is wild enough, but how did you get into this?
So I actually have a really good friend who's a real estate agent. She introduced me to Frank, and he pretty much walked me through what I needed to do to be a loan officer. I was looking for a career switch.
Career switch? Okay. All right. So, Frank, you're not a newbie at this. Most people will see you and most people will think like, oh, he must have just started doing this. You've been doing this for some years now. So talk to us about that.
Actually, I'm a dinosaur. Okay, let's just get right to it. I'm a dinosaur. I have been doing this an extremely long time, but I've been very blessed to be rejuvenated every morning.
Right.
When it comes to doing this job, to be able to put people in houses, whether it be families, whether it be single moms, single dads, whether it be young, old, or any, to be able to close and put a person in the house, it's an amazing feeling. And to be able to have that type of power, as well as authority that's been given, you don't take that lightly. So you really want to stay grounded. You want to work. You want to show people the truth of how to get this money and be homeowners. Right. And that's what we do.
So, there's a lot of people watching, and I'm sure there's questions going to be popping up here shortly. What are some of the misconceptions that, some of your clients you find have when they come to you looking for a loan to get into a home?
I gotta have a high credit score. No, you don't. You could have zero credit.
Zero credit.
Zero credit. If you have not had anything in your name at all, but you have maybe a utility bill, car insurance, gas, light, rent in your name, 3 alternative trade lines of credit, we'll be willing to help you get into a home.
Now, I got to tell you now, you're probably going to have some people calling y'all up right about now saying, zero credit? I ain't got no credit. That's me. Like this, he's talking about me. Like this, and you can work with that person and get them into a home.
You know what the minimum criteria is to buy a house?
What's that?
A 2-year work history.
Really?
Not on the same job. A 2-year work history is the minimum criteria to be a homeowner.
Wow.
How many people got a 2-year work history?
Man, can I shoot 2 years, man? I got like a 40-year work history. I can divide that up and give me a few houses then. Hey, we got a couple questions up here. Let's see. We got the first question here from Ms. Humphrey. She says, what type of loans do you offer?
We offer all of them. We offer FHA. We offer conventional. We offer VA. We offer USDA. We offer jumbo. We offer non-conforming. Okay, now you said, what's non-conforming?
Forget non-conforming. You need to back up 5-4 loans behind. You said jumbo, FDA. I mean, you're gonna have to break all those down, Frank. Come on now. We common folk around here.
Okay.
Come on.
So FHA is your typical government loan.
Okay.
They typically are going to ask you for 3.5% down for your down payment.
All right.
They will allow you to use down payment assistance or a gift from a friend or a family member. Okay. Now, many people are not aware of this, but if you have been on your job for a period of time and you're vested into your 401k, you can pull money from your 401k without being penalized to purchase a home.
Really?
Absolutely. Absolutely. And if you do it at the beginning of the year, you got the rest of the year to pay it back.
Right.
So great way to have your down payment coming from your own funds.
Okay.
VA, there is no down payment whatsoever. Okay. So you are a veteran. If you have the VA eligibility, you're going to get 100% loan. And those can start at 0 or 500 credits going up.
Wow.
Okay. USDA, it is not a down payment assistance program. It is a true 100% loan, just like your VA loan, except you don't have to be a veteran. You only have to meet the criteria of buying in the county, and you have to meet the income criteria. Meaning, if you have a family size of 4, you don't need to make over $117,000.
Man.
So if you've got 2 parents that are working, let's say that they're making $50,000 a piece, they can fit into that criteria by along with USDA, 100% financing. You can't beat it. Okay. Conventional, you actually have an array of products with conventional, but typically as a first-time home buyer, they come in at 3%. Okay. There are some 0% down conventional programs. They have a few different caveats to qualify, but they are available. Typically conventional, you do 3%. You come in, you can buy 620 credit scores, what conventional will ask you to have for the minimum. Okay. It's not government loan. It is a private money loan. Okay. Now, non-conforming. When you have the strangest situations, I ain't paid my taxes. I ain't got no Social Security. I ain't got no job.
Now we're speaking.
You get into all of that. That is what we call non-conforming loans. Okay. These loans will not conform to the normality of what you're supposed to have to get into a house. All right. So if you don't have taxes, let's say that you're self-employed, you're not either claiming the right amount or you're not claiming none at all. You're going to put more down, but you should have the cash. So now we'll do a bank statement loan or a profit and loss loan, just a P&L statement saying how much you make.
Right.
We'll use that income to allow you to buy a house. Now, on those loans, you will put 10% or greater down because we're not verifying your income. Okay. Let's say it's a bank statement loan. You hadn't paid any taxes, but you can show me 12 months of deposits that average 50, 60, 70, whatever it might. Okay. We will use that income on the average. That's your income for the year, and we'll qualify you. Now, you will put about 10% or more down on those loans too. But here's what I tell people. If you ain't paying Uncle Sam, you should have the money. Okay? If you're not paying man, oh, you still have the money.
Right,
And
right.
so usually that gives an alternative for those that might not meet the standard way of doing business.
Okay, all right. We got a few more questions that came up here. It says Miss Pamela Rayford Fry. She says, "Where does the money come from that's used to give out for loans?"
Oh, that's a great question. It comes from the feds. Okay, the Federal Reserve gives money. They lend money out at a rate. Once that rate has been released to the banks or the lending institutions like myself, we sell that at whatever the going rate is for the market. Okay, based on your credit, based on your loan amount, based on the type of loan you're doing, that will determine what kind of rate you will get.
Okay, we got a statement here from Mr. I think that's Neveth. He says FHA, conventional, VA, USDA, and jumbo, which I don't think you covered jumbo. I'm actually covered after I finished reading this.
Sure.
And non-conforming comes from wholesale investors. What is a jumbo loan?
Jumbo means that it is outside the standard loan amount. So, for instance, if you go into 7, 8, 900,000, those are not standard loan amounts. Those are going to be considered a jumbo loan amount. Okay.
Got it.
When you start getting into that high of a loan, they have different criteria for jumbo. You might only get a 90% loan versus 95 or 97 because now you're financing such a large amount. It's more risk for the investor.
Right.
So now the investor wants to have you put a little bit more skin in the game.
Tracking.
If you're doing $1 million and it's 90%, you got to put down 100,000. Okay. If a person puts down 100,000, it's very less likely that they're gonna lose their home.
Right.
Okay. So they have a little skin in the game. All right. So that's what jumbo does. Jumbo is a much larger loan amount, which requires the client to put a little bit more in.
Okay. We got another question up here. It says, why don't you guys just look at your job history instead of your credit due to today's situation?
Miss Humphrey, that is such an awesome question. The way that we have to answer that is this. Your job history does more. I mean, your credit history does more than just X's and O's. It gives us an accountability of how you pay your account. So if I want to fight, I'm a lawyer for all my clients, okay? Because we're gonna call the underwriter God. All right, or the judge. We're gonna call it underwriter judge, and I'm a lawyer for my clients. So I'm fighting if they don't have the perfect file. I'm fighting to get that person approved because I believe in the file.
Right.
Okay. Now, when you have a person that might have some blemishes on their credit, you have to actually ask those person what happened. What's the reason? Is it negligence or was it a situation? If it's a situation, well, the person that's underwriting your file is a person.
Right.
Let me talk to them about the situation. Let me give them an understanding that you just did not forget or you just didn't just lazily not pay the account. There was a situation that caused a hardship. You were late on it, but you didn't go 2 months late or 3 months late. You caught the account up and it's been current. So your credit history is very important for us to fight for your file because it tells the underwriters your ability to repay accounts back on time. So as much as we would love to just go off of just income, what if you just got a job yesterday and you're making a lot of good income, but you don't know how to budget? So if I give you this house, you still won't pay for it because you're not good in budgeting. Okay. So we have to go a little bit deeper and we have to look at 3 factors: work history, credit, and income. Okay. Those are going to be your 3 major factors.
Okay. So Shauna, you're the loan officer. How often do you find yourself in a quandary? You're like, oh man, I really liked Mrs. Jefferson and her husband, and they're such the sweetest couple, and they really need this house. You know, how often you find yourself in that position? Do I do it? Do I not do it? What is that like for you?
It definitely happens. It more so varies on the situation. Like Frank was saying, you have to tailor each file to that particular person. So it really just varies on what exactly they have going on. Even though it may be a no right now, it doesn't mean that I can't help you in the future. And so you just have to educate them along the way so that you can get there.
Okay. And when we were talking backstage earlier, you guys, you're not always getting the perfect files that are coming through to get these people into houses. Sometimes y'all are having to, travel some miles and valleys and low ups and downs to make it work for them. What is that like?
It can be extremely trying at times, because a lot of people do not know what you have to go through to get that file approved.
Right.
You can tell a person to do this, and then that changed the reflection of this and this. Somebody might say they work 40 hours, but when you get their paycheck stubs, they're not working 40 hours the whole year. So now their year to date does not match up to that.
Right.
So
right.
to try to explain that back in January when you were not working 40 hours, but the last 3 months you have been working 40 hours, year to date adds up. It's mathematics. It's got to add up. So if it doesn't add up, underwriters or investors are going to say that your income is variable.
Right.
Okay. And so from that, you have to come up with solutions to that. Sometimes you have to go back 2, 3, 4 years to show that this person had a stable work history with either overtime or commission to get the underwriter to investor to be able to meet the guideline to be able to use all their money, to use all their hours. To if you hadn't been commissioned for 2 years, which is supposed to be the guideline, you can also go and say, okay, well, they commissioned on another job. Let me go get that work history. So you do a lot of work a lot of times to get people full credit for their income.
Right.
And you would be surprised that many people don't know how much they make. They know a roundabout figure. A roundabout figure doesn't work for us.
Right.
Because I can't give you a roundabout approval. Okay. So
all right. We got another question out here. It says, let's see, how far do you go back to look at your credit before buying a house?
That's a great question. The credit report itself is going to be its own history. The impact to credit is usually the last 24 months. We're going to look at what impacts you the last 24 months. Now, bankruptcies, foreclosures, they can have a longer grace period on your credit report that can affect us in the approval. Okay. But if it's not some what we call credit event, like a bankruptcy or foreclosure, and maybe it's just a late or a collection, typically what we're going to look at is there are 2 types of approvals. Let me go there. Let me share that. Let's make sure we understand there are 2 types of approvals. There's an automated approval. I mean, I put your stuff in the computer and the computer says, I like it. Approved. Right. Then I can put it in there and the computer might say, Well, if you get a that means that somebody alive has to look at that file.
Right.
Okay. Now that file is going to take on a different context because Mr. Charles has to sign his name on that file. Whereas this is a computer-based approval. Okay.
Right.
Mr. Charles, you are going to be liable if these people don't pay this mortgage back because you signed off on it.
Right.
Along with Frank Brown and everybody else that's associated with that loan. So we have to do a thorough job. And in doing that, if you get a manual-based approval, it's going to ask you for a lot more information. Right. You can't have any lates in the last 12 months. You can't have any revolving collections or installment collections go bad in the last 24 months. Okay. So those things can impact, even though you might have the credit score to purchase, you might not have the credit criteria to purchase.
Got it. Now, and I want to ask something on that, but we're going to go to this question from Miss Jasmine Jones. Is that Janessa Jones? Says tax seasons is approaching. How do you recommend people best use their income tax refund?
Oh, that is a wonderful question. So think about it this way. A lot of times there's either the down payment or there is a certain amount of money that you need to just be able to get over the hump. Sometimes you don't have a job that allows you to get large sums of money, or you're not in a position where you make commission or extra money. A tax refund where you get $5,000 or $6,000 back could be the missing key of what you need to get into a home.
True.
Okay. So what if we put you in a down payment assistance program? What if you paid off some debt and you get the seller to help pay closing costs? And now you need to get into this house. And let's say it's a $300,000 house and you can get in there for $3,500. You got $5,600 back on your taxes. Let's go.
Right. Right.
So it gives them that opportunity because they got that windfall of money. That is the best investment that you could do with your tax money.
I think you know the answer there, Ms. Jones. We got another question that says, what if I have the money but not the credit? Then what? Woo! Charles is sitting on a goose egg. I got $800,000 in the bank. Frank, I want a house today.
Okay.
But my credit is 425. And I got some bad, outstanding collections on me.
Well, Charles, at 425, the answer is always going to be no. So what we're going to probably do is have you take that 800,000, buy the house cash, come sit and talk with me. Let me get your credit right. And then refinance you later to pull some of your money back out so you don't have to be cash poor.
Right.
Okay. But at a 400 credit score, let's just give you an example. At 10 and you get 4, that's 40%. That's failing in any category.
Right.
Okay. We can't do loans in a failing situation because to the investor, they're thinking they're not going to get their money back.
Right.
Okay. So we don't start out putting people in situations that are just not going to benefit anybody. Because the way that money's going to work, I want to, if I came and said, hey, can I borrow $10 from you? And you said, yeah, Frank, because you know me, I paid you back before. Then Shauna comes and said, can I borrow $100 from you? Because she saw you give me some money, but Shauna's never borrowed any money from you. You have no credentials. You don't know much about Shauna other than the fact she just smiled and asked you for $100. Now you got to make a business decision.
Right.
Do I give her $100 and chance losing this 100? Or do I just say, no, I probably need to keep my money?
Right.
So that's what you deal with when you have low tier credit scores like that. Okay. So typically under 500, you don't have investors that'll give money. At 500 and up, you have investors that are going to give money.
Okay.
Now at 500, which is a minimum criteria, they will make you put more in. 10% higher rate.
Right.
So now if you come to me at a 525 credit score and I'm able to get you into a house, it is not the best loan. It is not the best financial situation because you will have to come out quite a bit more money than you would have normally had to.
Right.
Okay. And so if you're in a position to do that, then we're going to help you. Okay. But we're going to also educate you because I don't want to put people at 8% interest rates when they could have got a 6.5% interest rate, all because they wouldn't pay their bills on time so I could help them get their credit scores
right.
up. Okay. So we talk to people because you'll be so surprised when COVID and a lot of people died, a lot of people got money from the deceased. And when they got that insurance policy, they took that money and bought a house. And we did a lot of loans that way. But at the same time, we tried to help change their pattern of thinking as well as their spending because they got that windfall of money.
Exactly.
Okay. So, yeah.
Okay. Got another question up here. Which one is this? If I get the producer to scroll it down some so I can read it because it's too far up.
So who do you blame for the 2007-2009 housing?
It's that one there. Come up. It says, what fees should clients expect to pay before the down payment and closing cost?
Before down payment and closing costs, there's really only going to be about 2 fees: credit report fee, possibly 3. Credit report fee, home inspection, and possibly earnest money when you're writing your contract.
Okay.
Okay. Earnest money is negotiable. So there's no set fee exactly what that could be. That could be $50. It could be $5,000. When it comes to the home inspection, you're not required to do that. But why would you spend $300,000 and wouldn't spend $350 on home inspection to make sure the house is worth buying? Okay,
Exactly.
And then the credit report fee. Just like doing if you go to your mechanic and you need to figure out what's wrong, he's going to run a diagnostic. Now, whether you fix the car or not, you still had to pay for the diagnostic.
Right.
That's what the credit report is. It's a diagnostic. Okay. We're going to pull a diagnostic. That's your investment into moving forward. Now, here's what I tell a person. If you won't pay $50 or $60 for your credit report to get into your $300,000, $400,000, $500,000, $600,000 house, what are we doing?
Right.
Okay, what are we doing?
Exactly.
So that's the minimum investment. So those are the things that are typical to pay before you would actually close on your house.
Okay. Got another question here. It says, who do you blame more for the 2007-2009 housing loan? I can't read that crisis. The institutions for giving out the subprime loans, or the borrowers for attempting to buy homes they knew they couldn't afford?
Oh man, that is such a great question. It actually is a equal accountability blame right across the board. The banks and investors are just as responsible as the people who walked in there asking for it. Okay, because here's the situation. When a person comes to you to ask you about a home, you have an array of loans and an array of products. That's how the industry is set.
Right.
You look at a person, and once again, just like us, most banks or mortgage companies, they're going to tailor that loan to you. Okay. Well, when you come in and you want to buy a $2 million house because your neighbor bought a $2 million house, but they can truly afford it. You can somewhat maybe close to afford it, but you want to go ahead and get it. And now they have these products that would allow you to get it, even though you probably might not can afford it, but we're going to put you into a negative AM. They don't do these anymore. They'll put you into a product a few years back, which led to the mortgage crisis, where there were negative AMs. So let's say you got a $1 million house where the payment should probably be $6,800 to $8,000. Okay. But now that payment is $5,500. So now you didn't got into a $1 million house, but it's a negative AM payment, meaning that $5,500 don't even pay the interest on the loan. It pays a portion of the interest on the loan. Okay. So it recasts, it retasks, you owe, you never come in and make lump sum payments 12 months down the road. You're upside down. You can't refinance because you got the payment that's higher than what you make. Then you also went out about 2 Benzes to match what the neighbors do. So you got $1,000 car payment on each car.
Right.
Now you have bought yourself right out your house and put yourself in a position where you can't save it.
Right, man. Got another question here. It says, how is it even legal to give out NIUA loan? Ninja
no
loan?
income, no asset, no job loan. How is it legal? It is legal because investors have weighed the risks on that. So, for example, we call it asset loans now. They're not called ninjas, but asset loans mean you sit down with me, Charles. You say, Frank, I got $600,000 in the bank, but I'm not currently working, but I really want to buy a home. Okay, I'm gonna take that $600,000. I'm going to divide it by 5 years. Whatever that comes out to be, that's your yearly income. I'm going to qualify you on a 70% loan. You're going to put 30% down. So now, if you sitting on that type of money and you have that ability to put that amount of money down, the investor has done the numbers to say that these loans perform. Most people don't know when it comes to banking and finance. Think about it like this. How often do you check your money?
Daily.
Okay. Bank check their money hourly, minutes. Okay. They're going to check their money all the time. So from that standpoint, they're not going to just, let's see how we say, they're not going to just give you the money without doing their due diligence.
Okay.
Okay. And so with that being said, you gotta be in position to get it and deal with it. That's the only way. That's the only way the bank is going to look at it. Okay, you got to be diligent about that. Okay,
All right.
got to be.
Ms. Jones got a question. She says, if a builder for a new construction home has a preferred lender, can you still help?
Yes, we can. That's a unique situation, and what we have started to do is provide a service that would match or exceed what the builder's lender can do.
Mm-hmm.
At that particular point in time, we go to the builder and provide and show them what we can do and ask them for an opportunity to be able to close that client with the same benefits they were going to give their preferred lender.
Okay.
A lot of times, being very straight and direct, we get that opportunity.
Mm-hmm.
Okay, and yes, we can help.
Okay. All right. I got a comment here. Hey, it's the boss man. Got some fans out there watching. All right, giving out that top-notch information. Another question here says, if I have land, would it be easier for me to build with a 580 credit score?
No. Land purchases and land loans are different because you don't actually have anything to live on. That is a much higher risk loan. Okay. If I give you money to buy land, you can't sleep on the dirt.
Well, I think this one's asking if they have land. They already got the land.
So they have the land.
They have the land.
So they want a construction loan.
Right.
So once again, 580 on a construction loan, no. You're going to need to have at least a 620 to do a construction loan because you're going to need to be able to build. And in the same word, you possibly might have to pay interest depending on what type of construction loan you do. There are multiple types of construction loans. Some do not require you to pay interest until the builder is completed. Some do.
Mm-hmm.
Okay. So it just depends on what you're going to qualify for. Now, with a 580 credit score, we could probably get that person up to a 620 and do an FHA, one-time close construction loan. Okay. And what that basically means is that person would select their own contractor.
Mm-hmm.
We would get that contractor approved with the investor. We would qualify that individual based on the total cost of the project. Okay. And then based on that, they would get that money closed, and that contractor would be rationing that money out in 4 to 5 drops to complete the house.
Mm-hmm.
Upon the last completion, where they knock the last nail in, the appraiser will go verify that everything's completed. They get the last draw.
Okay. So, I have a question in regards to that. On TikTok, I'm in that TikTok. My grandkids be like, G-Pa, what are you doing on TikTok? So I've seen a lot of TikToks where people have built homes on land and come to find out that it's more than what they can afford because they didn't take into account the cost of the escrow now. Because when they had the land, they were only paying $80 in taxes. Now they done built this house, and what they thought the loan was only going to be for $1,000, but the escrow kicked in because of the property value. Now they're paying $1,500 or $1,600, but they was only banking or budgeting on that $1,000. How does one navigate that?
That would be hard for me to understand because technically, as a mortgage banker, I'm going to share those numbers with you on the front end.
Mm-hmm.
So we might not be exact, but I'll give you an example. If it is just a plot of land, your taxes are going to be very small.
Correct.
Okay. But now you go build a $400,000 house on that. It's going to be reassessed now. So what I would share with the client is let's ask your neighbors what their rents are. Their property
taxes are,
to get an idea of what your property taxes are going to be.
Tracking.
Okay. So then that way you're much closer. So let's say we chose the number 1,800, but you get your property tax is $1,950. It's only $150 divided over 12 months.
Right.
It's $12 change. All right. So that's not going to be that's not going to cost you lose your house.
Right.
Right. So on that particular situation, I would say maybe the institution that helped them failed them and not giving and doing due diligence to make sure they understood what your taxes and insurance are probably going to be on this property.
Right. Okay. All right. So, Shauna, let me ask you something. pretend Frank's not here. All right, pretend Frank's not here. What is it like working with someone who is meticulous and diligent as Mr. Frank Brown is?
Honestly, I think it's great because you learn.
Mhm.
And I think in this industry, you're constantly learning. And that's the best thing that you can do because things are ever changing.
Right, right. Did you ever have that time where Frank had to say, "Shut up, no! Why would you do that?" You know.
No, I'm not going to say that. I don't want
You
to
over here laughing now.
No, we're not going to do that with Jesus. No.
No. All right, that's good. That's good. So, in a roundabout ballpark figure to date, how many loans or how many families do you think you put into homes?
Year to date, we're right at about 75. Yeah, we're right at about 75. So after this month, hopefully we should have about 7 or 8 closings. So we'll end at about 85, 84.
85, 84. Outstanding.
So
Outstanding.
that's great. With the market that we've had this year, it's been a little up and down. And to be able to have closed 85 loans and upwards of probably 21 to 23 million dollars move, that's phenomenal. That's
Outstanding.
phenomenal. So I'm proud of the group.
Hey, folks, those who've been watching, those who've been answering these questions, hey, we definitely appreciate all these questions. And Frank, for those who are watching, because we got viewers in Georgia, we got viewers in Tennessee, Texas, Alabama, Pennsylvania, how about give them some information if they want to get a hold of you? If they want to have GTM be in their corner, how do they get in contact with you?
First of all, you can call us. You can call me directly, 256-990-3546. I have a wonderful team. Sometimes I can't take calls. You'll speak with Shauna. You can speak with Nicole. You can speak with Janessa. You can speak with Amanda. You can speak with Tyshawn. There are groups. You can speak with Pam. We got so many people that are willing to help with a plethora of knowledge. Okay. And the information that we share is universal. It can be used in other states. Now, if you want us to do business in the state, call us. Let us know your favorite real estate agent so we can get connected with them. And we'll get licensed in that state so we can work and help your community.
Outstanding, outstanding. And speaking of helping the community, and folks, and I'm letting him tell you this part, but you're actually looking for a particular agent to get on your team to help. Go ahead and tell us about that.
Yes. Okay. So we're so big in educating our community.
Okay.
And we want to make sure all communities are taken care of. So right now we are looking for a Spanish-speaking loan officer so we can actually do more for our Latino community and be a much bigger force in educating them and teaching them how to buy more houses and how to get fair loans. Okay. It's ridiculous how good they work and how on top of their business they are. So they should get just as fair loans as me and you when it comes to buying real estate. So we want to educate a loan officer that can speak Spanish fluently to help their community and get stronger and make good money and do a good thing.
You know what? The big part that I like about what you're saying is that you want to educate them. You want to show them how we're going to do this. You're not saying, oh, you need to already come in and have 5 years of being a loan officer and you've had to given out 1,800 loans in the last 5 years, 10 years. You're going to educate them. And I think that's awesome. I think that is awesome within itself right there. So folks, if you know someone out there, especially if you're in the Huntsville area or the Decatur area or around in this area, period, that someone who is speaking Spanish and wants to get into this, please reach out to Frank Brown so that we can get that he or she on board like this and get them started. We got a couple of statements here. We got someone says, what advice would you give to a first-time home buyer?
Wow, that is a loaded question. One, I would first tell a person, if at all possible, do not change jobs while you're in the process of trying to get pre-approved.
Okay.
But if it is a step up, meaning, let me share this. Let's get more detail. Let's be a little bit more specific. If you have a job that you've been working for 2 years and you make overtime, that overtime can be included because you have 2-year work history of overtime.
Right.
It can be averaged. All right. As soon as you leave that job and you go to another job, regardless if you're making overtime or not, the only way I can give you credit for overtime is if we go back and get all the overtime that you made for that other job to be able to average it.
Mm-hmm.
So if you were averaging a lot there because you've been there for a while, but then you come here and you're not averaging that much, that could affect your debt to income or your money. Okay. So I would tell a person first, if at all possible, try to be on the job that you want to be on, that you're going to qualify on. Okay. 2, do not go out and just randomly let people pull your credit. After you go to a mortgage company, 1, 2, 3, or 4, or 5, and they pulled your credit or access your information, do not go to furniture stores. Do not go pre-buying your information for your house until you close. That's extremely important. So no ill-advised inquiries. Okay. 3rd, as much as we would love and help you get into a down payment assistance program, there's nothing better than you saving your money.
Right.
Okay. Let me tell you how the industry changes as it monitors money. If I give you down payment assistance money for 3 months, I'm watching how this money operates nationwide. Mm-hmm. Do the people pay it back, or does it go into default? Now, if it's going into default, if there's a rate of percentage that is unliked by the investor, the next quarter, the way that money operates changes. So now, for instance, I'll give you a prime example. I could put a person in the house, down payment assistance program, no money out of pocket. They literally are going to go to the table and they don't have to have anything but a good pen. Mm-hmm. Now investors will say you need to have 2 months reserve. So if your mortgage payment is $1,500, right, you don't have to have any money to close, but to finalize that loan, you need to have $3,000 in savings. A lot of people might not have $3,000 in savings. They can meet all the other criteria. They're going to buy a house with no money. But because down payment assistance programs might underperform, now investors have come up with a caveat to make them perform better. These loans work better if you have 2 months reserves. Right. So that's important.
Got it. Another question here says, how many times would an appraiser have to come, 1 time or 2 times?
That depends on the property and that depends on the situation. So I'll give you an example. You got a brand new house, the appraiser goes out and everything is perfect when he goes out the first time. He's not coming back out. He's going to give appraisal as is. It has the value. We're good. Same situation, brand new house. He goes out, but the house is not 100% completed. And when I say 100%, I do mean 100%. If everything's done and you just don't have the countertops, it's not 100%.
It's not 100%.
Okay. He's going to ask to come back out and you're going to pay him to come back out because he's going to charge you a trip fee. Right. Okay. Let's say that they do an appraisal on the house and there's something that needs to be fixed. For example, on FHA, if you have peeling paint, that is a violation on the FHA guidelines. So the appraiser can't sign off on the appraisal until you scrape the paint and repaint it. Okay. Wow. So there are things that can cause an appraisal to come back out more than once. As long as the property is good, he's typically going to go out there 1 time.
Okay. All right. Good deal. Good deal. You know, one question I had before we close, and you were talking about it earlier, when we talk about someone who's in a bad situation and that credit score ain't there, but they got the money or the loan that the one young lady mentioned about, it's a bad loan. Is it better at that time for that individual to continue to rent a home instead of paying that high interest rate and putting down that absorbent down payment?
No. If you have the resources, use them.
Okay.
Here's why I say that. Let's say that you can get into a house, you got to exhaust everything, but you can get into a house. And then I still work with you 6 to 8 months to help you raise your credit. And then you're able to refinance in 8 months or 10 months or a year, and you save some money. But same situation, I'm going to work with you for 8 to 10 months. In 8 to 10 months, that same house you was going to buy is way more.
Good
so
point.
Now you cost yourself money.
Yes, good point. Good point.
That's the part of educating people to understand if you have the ability to do it, you never know what's changing in our market for tomorrow.
Right.
Let's close today. Okay. And then we'll work on the stuff under the bridge so it'll be better the next time you come.
And not only that, not only with the price of that house can go up, it might not even be there.
Absolutely.
You know, because when I was searching, there was someone, well, let's go back to that other house. Yes, there's someone's already got money on that. You know, that one's off the market. I'm like, man, that was just 2 days ago. Like this. So that's a good point.
Let me share one more thing, because this is going to be important. I'm glad you said that. Plus, when the market goes down, and you might have had a chance to experience this when COVID and the market was low, people had to bid $20,000, $30,000 more.
Yes, I do.
Okay?
Yes.
So now, why would you wait for the feds to drop the rates to put you in a situation when you have to buy a house? You got to come out $20,000 more to get to bid on the same house that you could have got last year.
Yeah.
Okay. So I tell people, watch what you wish for. It will come because the market shows the trend. The trend is the rates go up and down.
Right.
Okay. That's a trend. All right. So now if you know that, get the house when you can get the house. When the trend goes down, we refi.
Right.
Put yourself in a position where you're not having lates and you have not overspent your money and you have a bad debt to income. So when the opportunity comes for us to refinance, you're in the ability to refinance.
Outstanding. Outstanding. All right. We got one last question we're going to take. If we can get the producer to bring that up. I see it popped up in the corner. Great information. Okay. Thank you, Jones. He just wanted to put up there saying great information. Hey, Frank, Shauna, hey, I appreciate y'all coming in tonight and sharing this information. There's been a lot of great questions out there from the viewers. You have put in a lot of good information. I'm definitely going to have you come back out. If not for this, come speak to one of our entrepreneur classes.
Sure.
Let them know how you got started and what you're doing. I'm definitely going to put your information out there because, as I said before, if I don't know, there's somebody else who don't know. And I want to make sure everyone gets to know who you guys are and what y'all are doing and how you are helping our community. All right. Folks, thank you all for sharing and coming in this evening. As always, remember, your yesterday is not your today, and your today is not your tomorrow. Good night.